Hey there, it's Mitch Goldberg. We're live. Thank you so much for joining me on my daily podcast where we talk about personal finance, investing tips, business, and other pertinent kinds of content. It's all about making you the best possible financial version of yourself. Be the boss of your money is the name of the podcast. I am so glad you're joining me. It's easy for your money to become the boss of you. We get stuck. We get stuck with a expensive lifestyle. We're always chasing some kind of superficial dream. Not always, and not all of us. But the point is, I want you to be the boss of your money, not your money to be the boss of you. I want you to get your dopamine shot from saving, from doing something good for you. Go to the gym, exercise, put some money away. Invest in a ETF or a mutual fund or a stock. Not trade, invest. Do something good for you. That's a great way to get a dopamine rush. I'm not saying you shouldn't go out and get a cup of coffee or buy the new toy, but hey, listen, I want you to be the boss of your money. And I promise you, almost almost every possession that you have is going to end up in a landfill in a pretty short amount of time. If not, it'll wind up in your garage or your basement. Just the way it is, folks, right? That's why we talk about experiences above and beyond things. I digress. Welcome to Be the Boss of Your Money. We're talking about value stock investing, why it's so hard. It's much easier to spot growth opportunities than value opportunities. I will tell you why. Spoiler alert, most value stocks are really value traps or value crap, depending on how you want to say things. So thanks for joining me. You're watching Be the Boss of Your Money. We're going to talk about why is value investing so difficult. Let's roll the quick intro, and then we are going to get into this. All right, we're back. I am so grateful that you joined me today. Thank you very much. We're talking about being the boss of your money. Be the boss of your money. I think it's catchy, but more importantly, I really do want you to be the boss of your money. I want to make you a better investor. I want to make you better at personal finance. There's a lot of things you could do better in business, and I would love it if you would ask me questions during this live stream. So welcome to you. If you're watching in the replay, welcome to you as well. If you ask me a question and you're watching this in the replay, I will get the notification. I will see it. I will get back to you. And it's the best part of doing this is actually, receiving your questions and having an opportunity to interact with you. So, excuse me, little allergies to a little stuffy. So I would love for you to, be a part of the show and join me with some questions. We're just getting started. So welcome. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. We're going to start with a quick share screen. This is how we always start. We're going to go through this very quickly, and we are going to take a look at the market today. Let's call today Rebound Tuesday after yesterday's drubbing in the market. The Dow yesterday was down over 500 points. Today it picked up a little bit, up 140, a little bit on the S&P, a little on the NASDAQ, more than a little on the NASDAQ. NASDAQ had a good day, but the NASDAQ has actually been getting hit the hardest the last couple of weeks. Listen, I said yesterday's episode that we are definitely due for a little bit of a bounce back. We don't go straight down. We always have these bounces. But my point was yesterday, and I'm sticking with it, is that until we get another stimulus package for the economy, Republicans came up to I think 1.5 trillion. Democrats started at 3 trillion. They came down to 2.2 trillion. They have to meet somewhere in the middle. It's tough though, because now, the political energy is all about confirming a new justice in the very near term, ever since the death of notorious RBG Ruth Bader Ginsburg. So we have a couple of things to get done in Congress. So I really don't see how we get a stimulus package done over the next couple of weeks, 40 some odd days until the election. And then after the election, it'll be even harder to get a stimulus package done. And then we go into Thanksgiving, we go into the holidays, we come back, then we're into the next inauguration, whoever the president is at that time. It's really tough to envision anything getting done before next February, and then we get into winter recess for Congress as well. You see how we don't get things done in this world? It really, I think everything should just be electronic, and Congress should just stay in their seats until things actually get done. What do you think? Are you with me on that? I think it's a good idea. So that's what's going on. The VIX, the fear gauge, that's the red one. That's a good sign that it's off a little bit. Professional money managers are feeling a little more comfortable with their portfolios. They're paying a little bit less money for short-term hedges. That's why it's called the fear gauge. And it's so let's just move on, okay? Let's take a look at some of the stocks that rebounded today. Nike, Microsoft, Amgen, Visa, Apple, Disney, the usual suspects. Caterpillar's been hot lately. Coke has been pretty good lately. So these are the stocks that led the Dow up today. Again, today's rally, Tuesday, almost said Tip Tuesday. No, today's rally it's Recovery Tuesday, but not a big recovery. It's more like a bounce on a Tuesday. But I really don't, like I said yesterday, I still think the market has more downside without a stimulus package, or if we get, just a total unbelievable vaccine for COVID that is safe and effective and people believe in and trust. That's a tall order to get before the end of the year. Let's keep going. The FANG stocks. Facebook up $6, up 2.6%. Keep in mind, this is over 300. So let's say 303. When you take a look at a $300 stock, let's just move the decimal point over a little bit. We'll say it was a $30 stock going to 25. That's a pretty big hit. Apple up $1.73. Amazon back over 3,000. That's an important number. Netflix up. Microsoft up. Today was just a good day for the FANG M stocks. So when you have these stocks up, you can't help but have the NASDAQ up. That pulls the S&P 500 because tech stocks are such a big part of the S&P 500. So that is what's going on over there. Let's take a look at reopening stocks. Reopening. Planet Fitness was up. Royal Caribbean. Marriott, not compared to how much they've been down the last couple of weeks. If you see the red over here, I don't know if you can see your little phone, but like you see the AAL, American Airlines, is all this line here between the high, the low, and the current price. It's all red. That's still sticking for a lot of these reopening stocks. Okay. Even Southwest Airlines, which is the best performing airline, it's a little bit below the midpoint. So let's move on, and then we're going to talk about value investing. That's what we're here for, folks. We're talking about value investing, why it's so hard, why it's much tougher than growth investing, and why, generally speaking, people buy value stocks, and they do poorly. They lose money in value stocks. We're going to get into that. Let's take a look at how the market did by sector by sector. These are the big ETFs that track each sector. So you have discretionary was up, communications. The communications ETF basically is more than half of it is Facebook, Google, and Netflix. It's so concentrated in those three stocks. I don't even know why you would have an ETF for that. Technology was up today. Let's see, it was the bottom. Energy was at the bottom, and financials. Listen, how many times have you heard me say this? Financials, XLF, XLE, energy, those are down. Industrials are up. You had a decent day, but you need financials, industrials, and I still think energy to go up to really have the takeaway that investors actually believe that the economy is it's on its road to recovery. When you see consumer staples up, like XLP right here, and you see tech stocks up, which is emblematic of the work from home, stay at home cohort, that's not really a bullish sign as far as investors are thinking. All right. So just want to move on there. So today was not a bad day. It was a mixed day. I'm glad the downside of the last few weeks has been interrupted. Yesterday we had the Dow down 4 days in a row, which is like the longest downturn in over a year. I know we've had bigger down days this past March, but 4 days in a row is a lot. So just want to share that with you. Let me get off the share screen. We're going to talk about value investing. Listen, if you have a question about value investing, I would love for you to just hit that comments, type something in, or if you're on your smartphone, type something in, hit send, reply, whatever, and ask. Because if you don't ask, you'll never know. Value investing is really tough for a couple of reasons. Most people don't really know what it is. And why is it so hard? Well, first of all, if you compare it to growth stocks are easy to spot because they're the stocks that are going up. If a stock is going up, presumably it's because the company has rising earnings and revenues or expectations of rising earnings and revenue. So that stock would be going up. Sometimes they're up a lot. sometimes sometimes they're up so much that they're easy to miss. And they're easy to avoid, some growth stocks, because they appear to be up so much that they're so expensive that you feel like you missed it. And then they go up even more, right? That happens a lot. So growth stocks are easy to see. They have earnings growth. They have often revenue growth. They have expectations. They may be expensive. They may have something called a high PE ratio. PE ratio is a value metric. You take the current price of a stock on the exchange. Let's say, a stock is $20 a share, and they're earning 50 cents a share. Then the price, is 20 divided by 50 cents. Okay, is 20. All right. So if it was $1, I'm sorry, it would be 40 rather. 40 PE ratio. I got it. But if a stock, let's say, is trading at 20 and it has a $2 earnings, then it's got a 10 PE. And somehow people think a 10 PE ratio, PE ratio of 10 is low, and maybe, about 18 is the market average for the S&P 500, and 25 and above is expensive. These are just like really bad rules of thumb. And I say really, I'm fixing my thing here. I say really bad. I say these are really bad rules of thumb because they're right just often enough to make you think you're onto something, to pull you in, just to be wrong. And they're wrong a lot. So I don't pray at the altar of PE ratios. I know a lot of investors, the first thing they ask, what's the PE? I want a stock with a low PE ratio. I actually think you're making a mistake. Now let's take a look at value stocks. They typically have a down chart. Their earnings and revenues are either going lower or they're expected to go lower. And this is the stuff that money managers, people who manage money often, they don't want them. They don't want to be stuck in them. They want to sell them really quickly. So these stocks could go down even lower than what their fundamentals, then the stock could reflect a worsening situation that is really even more so than what the company's true fundamentals reflect. Just like a growth stock could go up a lot, maybe that growth stock, the company isn't as great as you think. But if investors want to catch that ride, they often bid a stock up too high. So stocks are like a pendulum. They're either going too low in value or too high in value. But there's one thing about a pendulum. See, that's the international sign language for pendulum. Okay, but if you notice, they're hardly ever in the middle. They're just always swinging. They're not at the top. They're not at the bottom a long time. They're not in the middle. They're just constantly moving between overvalued and undervalued. Okay. So what is a value stock? A value stock is commonly referred to as a company that is out of favor. So what do you mean by out of favor? Well, a company that investors don't like, a company that maybe is having the actual company's having a tough time pleasing or serving its customers, or maybe they've met a level of their products becoming obsolete, or maybe there are newer companies with newer products and services that have, in the eyes of consumers, have replaced the older companies with the older products and services. And generally speaking, the metrics that people go by for value stock are PE ratios and stocks that are trading at or near year lows, which I think is awful. I really do. And a lot of people are going to be like, how could you say that? Well, this is why value investing is so hard. I made a video about this not too long ago, and I said I don't like value stocks based on PEs or year low. And the example I gave in this video is probably like 2 or 3 years ago. I specifically mentioned Ford and GE. Both at the time had low PE ratios, and the stocks were single digits near their bottoms. They're at the same price they were when I made the video. I said I don't like to buy these kinds of stocks because when you buy a stock with a low PE ratio, you're basically buying a company whose earnings are going down. And let me explain something. What happens is when a stock goes down, let's say a $100 stock that's earning $1 a share, so it's a P ratio, 100 divided by 1 is 100. Let's say that stock goes down to 10 and they're still showing $1 in earnings. It's a 10 PE ratio. Well, it went from 100 times earnings to 10 times earnings. Must be cheap. No, what that's telling you is investors are expecting their earnings to crater. And what usually happens is, the numerator went down to 10, but the denominator stayed the same. But the numerator in division is on the top, the denominator is in the bottom. What happens anyway is the earnings finally go down. So when you see a low PE ratio, it's just that expected earnings haven't caught up to the future actual earnings, and then the earnings go from $1 in this example to 80 cents to 10 cents to negative. And then you're on the hook with a Ford or a GE saying, oh, it's a value stock. One day it's going to go up. And I don't like low PE ratio stocks, and I don't like stocks at the year low. Stocks are at a year low for a reason. They're not at a year low because it's a great value, but only you are the one who's really smart enough to discover it. Now, I'm not saying stocks at a year low can't recover. I just prefer to let them bounce and see some evidence of a recovery, and then I'm happy to jump into that stock. I don't have to catch the very, very low, because usually what happens in my experience when I've tried to catch a low, and I'm sharing this with you, is I wind up catching a lower low and a lower low. I don't like to be in that position. I've been doing this for 30 years. I've seen this too many times. I avoid this. So if the stock is making new lows and they have a low PE ratio, you have to give it time to see what's happening. If you pay up for the stock, better to pay up for a stock that's in good shape, for a company that's in good shape, than to pay down for a problem. Okay. So that is that. I've got some notes here to make sure I don't miss anything. I have so many things to say about this, but we're almost done already. Okay. So value stocks are also known as companies that are turnaround plays. And this is the real thing about the important thing about investing in a value stock. A value stock, for it to have investment merit as a value, it's got to basically give investors two things. It has to give investors the confidence that things with the company are not getting worse. So at least this way, you could say a stock is bottomed out. At least it's not going to get any worse. And maybe they'll pay a dividend while you wait. The other thing is, and what does it take to get a value stock to actually go up? A value stock to go up, the value stock has to become a growth stock. The company has to somehow turn around and get their earnings and revenue growing again. Now, I don't want to confuse this with a cyclical stock like a smokestack kind of stock, companies that do well when the economy does well, and a stock, a company that does poorly when the economy is doing poorly, like a cyclical stock, heavy machinery, trucking, etc. Those just go up and down with the whims of the U.S. economy. What I'm talking about is, as far as a value stock goes, is a company that is really down and out regardless of the economy. So is that company still a viable company, or are they just going to somehow be a zombie company for a long time until they finally disappear? And I think that's where the mistake is made. People see a stock that's down a lot. They see a coal stock or a steel stock, and they go, oh, or now an energy stock. They say it's down a lot. It must be a value. Are those values, or is there something that can turn these companies around? Like if an oil stock is down, all the oil stocks are down. Do you see the price of oil recovering sustainably to get these companies stocks going up again? I'll give you an example. The best example I've ever seen of a value stock that's become a growth stock again is Apple. Apple almost went out of business twice. A lot of people don't know that Apple twice was very near disappearing forever. And then finally, they did something that it wasn't even a new computer. They literally just came out with the iPod. The music, and it was like it was bigger than this. This is a iPhone XR. It was bigger than this. It was thicker than that, and it could hold a whopping 1,000 songs. And it was just because they figured out that they could, with more storage capability and shrinking storage devices, that they could put more songs in it. And then, they had the iPod Mini, then the phone, etc. So Apple really reinvented itself and became a growth stock again. And I think, if you look at coal stocks, or, steel stocks, like what I just mentioned, I think the idea here is that a value stock, if you're going to say, oh, this is a good value, and I see a lot of talking heads talking about value stocks are saying, oh, that's a value stock. It's down so much. So that they could turn around. That industry will turn around. Not every industry turns around. And sometimes it takes forever to happen. And a lot of people are saying bank stocks are value stocks now. Now, I will agree that we will have the big banking companies, the Citigroups, the JP Morgans of the world, the Bank of Americas. Okay. I believe that those companies will be here 5, 10, 15, and 20 years from now. That doesn't mean that their earnings improved. It doesn't mean that their revenues improved. Maybe they could cut more fat and become more and more just, internet businesses. And that will somehow help them be valued more highly by Wall Street. Wall Street loves companies that are asset light. So as banks which have branches convert those branches to ATMs and move everything toward digital and onto apps, the banks become more profitable per transaction. But, that takes a long time. So that's why value investing is so hard. It's not just a matter of stocks that are down or somehow magically value stocks. It's automatic. It's down with a low P ratio. It's got to be a value stock. No, when a company is down, it's not a value stock. It's just a lousy investment that you should steer clear of. And the last thing I'll say is, this is why I don't think index investing works for value stocks. I have no problem with index investing. I have a lot of clients in index tracking, ETFs, and mutual funds. But just so you know, you can't actually invest directly into an index, but you could invest in a security that tracks or mimics an index. There is a difference. It may be subtle to you, but there is a difference. But I use tracking stocks for various indexes like the S&P 500 or value indexes or small cap indexes, mid cap. I use those. But what I'm telling you is I don't think indexing works for value stocks, because these indexes, what they do is they just do a screening of stocks that are down a certain amount or have a certain PE ratio, price to book or price to sales. But the problem is, just because they have these low mathematical metrics doesn't mean that they have growth again. And it doesn't mean that they're turnaround plays. They're just dying and getting worse and worse. They're dying companies. We're not investing in that. I just don't think there are enough diamonds in the rough to actually create indexes. It's such a specialized company. And of all the companies that you may think of as value stocks, there really are only very few of those that have the true potential to become reinvigorated or reinvented and become growth stocks again. And that is why value investing is the hardest part to me of the investing spectrum. I'd like to thank you for watching. I really appreciate you joining me. We talked about value stocks. Tomorrow, I'm going to be having a guest, Eric Ocon of BLS. Very cool guy, very interesting guy. Him and his brother Michael run a podcast as well, and they're just killing it. So I'm looking forward to learning from him what he's doing right with both his business and his podcast. And until then, I'll see you tomorrow. Thank you very much for joining me.